Okay, gang, I wanted to go over rolling again. That video I made kind of sucked. So basically, I want to go over rolling again. Somebody asked me a question on the rolling, which was under the rolling tab down here. Um, a nice gentleman asked me if I could do a video or at least explain why we're not rolling the tested side, why we're only rolling the untested side. Okay, so I'm redoing this video I made down here because mine sucks. So anyway, I'm gonna go over that right now. And there's a great series on Tasty Trade, and I actually put it on the forum under Golden Gecko. Under Golden Gecko here, there's a tab called, there's a new thread I started called "Where Do I Start with Kay Sosnoff, Managing Strangles and Iron Condor series." There's like 6 or 7 episodes she did here, some of them with slides. So just scroll down and you can go over all the different things she covered. So like in fact the last one she did is right here. If you scroll all the way down, it was defending iron condors. You can watch the video and she even has slides here. All right, so that's on the forum as well. On Tasty Trade, just go to archives here, pull up WDIS, Where Do I Start Season 2, Time and Case, and you'll see it starts right on August 15th. All right, so let's get back to rolling. I'm going to show you why we roll. There's 2 schools of thought for this, okay? One is Tom Sosnoff. The Tasty Trade way is duration over direction, meaning give it some time. And things kind of revert to the mean, so things usually more often than not correct themselves. All right, so let me give you an example of what I'm talking about. I'll go to my portfolio, and I'm actually in the money on TLT here. Okay, so let me show you. So currently TLT is at 119.05. I currently have on, I sold the 119 call and I sold the 115.50 put. And of course, I bought the outer wings, the golden geckos. But these are my short strikes. I mean, the strikes I sold. What does that mean? I'm betting if I sold the 119 call, which is what this stands for, it means I'm making a bet that at the end of 21 days, TLT will be below $119. As you can see, it's a little bit over already. How much did I collect for that? Well, look at your costs. I collected 42 bucks or 42 cents per contract. Okay. I also bought the further out call strike, right, which is the 120 call. I paid 12 bucks for that. So net 30 bucks, meaning I collected $30 for this portion of the golden gecko, this leg of the golden gecko. So which means I sold the 190 call and I collected 30 cents, which means my break even is actually $119.30. So as long as it stays below $119.30, I'll at least break even and not lose money. Okay. On the bottom side, on the put side, I made a bet that TLT will stay above 112 bucks. I'm sorry, above $115.50. I sold it. That's why whenever you see a negative, that just means you sold something. Okay. Whenever you see a positive, that means you bought something. Okay. Again, what did I collect? I collected $37 per contract or 37 cents per contract. And I bought the further out $8, so 37 minus 8 is 29, so I made 29 bucks on this side, right? Or I collected 29 bucks. Okay, now that's not how the trade actually started though. So I'll go to my history here, activity, go to history. Look, originally what I did was I actually originally sold the 112 put. Okay, now this is bought because I closed this, okay, but originally I sold the 112 put. Okay, which means that I was betting that TLT will stay above 112. It's at $119.05, so that part of the bet was good. Okay, well, because this position moved away from me, meaning, oh gosh, I'll clear this. Okay, so at the time it was down here. TLT, if you look, it moved up, right? Well, yeah, it's been moving high. There was a big jump in the last 2 days here, which caused it to spike up here. All right, so my put side was doing really well, but it tested my call side. See right here, if you click on that, I've got the 119 call. It tested it, right? So originally this was my put side. These were not my original strikes. It was all the way down here. So what I did was I rolled it. Okay, I rolled my put side up. So I originally sold this 112 put. So yesterday I bought it back for 8 cents, right? and I closed this top half of the trade. I rolled it. All rolling means is you're closing one and opening another, whether for a profit or a loss. There's no delaying a loss. A paper loss is a loss. Okay, so you're just closing one and opening one in the same trade. So on 28th, I did both of these at the same time. I closed this, okay, for a profit, and I sold it again. I redeployed and I sold it again, but at a higher up strike. I sold the same expiration, but I moved up my put strikes to collect some money. See, I sold it for whatever. Well, here 37 minus minus $5 or whatever it is, right? So I collected whatever. That's how much I collected for that part. So I collected more money. Okay, so I didn't collect any more on the call side. Why? Because I knew it could still come back. And the reason why I knew it could still come back is something called probability of touch. Okay, now probability of touch is really simple. When you put on a golden gecko in the first place, you're selling your put and call strikes, okay, approximately one standard deviation or as close to this one standard deviation line as possible on either side of the stock price, right? Here's the call and here's the put. If you click on leg, you'll see the percentage. One standard deviation is approximately 84% probably out of the money. Basically, you have an 84% chance that the stock will finish above this price and an 84% chance that the stock will finish below this price at the end of your expiration date, right? Now, there's also something called probability of touch, which you can't really see on Doe yet. I think they're adding it on. But you can see it in Thinkorswim. If you're using Doe to trade, you have to have a Thinkorswim account, and please sign up for that if you don't have one through Doe. Okay, so here's TOT. Here's what you do. You go to the trade page. You have your option chain. Open up your option chain, and it'll be your option chain. 49 days, for example. Remember now, what is one standard deviation away? Probably out of the money. 84%, right? So here's what I mean by probability of touch. See, you have strike. Here's the strike price. Here's your bid, ask, probably out of the money, probability of touch, return on capital. If your screen doesn't look like that, no problem. Click on this drop-down menu here, and you can select what you want it to look like. Hit customize. Add what you want, right? Click what you want, add item, and I'll move it over here, and then you can move it up or down so it looks like this, okay? All right, so 84% probably out of the money. Look what that means. Find it. It's between here and here. Let's just use 86 or 81, let's say. Meaning at $114, if you sell the bid, if you sell a put at $114, you have an 81.43% chance that it finishes out of the money, meaning above this price. Okay, it's at 119 now. But what are the chances that TOT touches $114 between now and 49 days? Well, look, that's what probability of touch means. You've got a 30-something% chance, 35% chance it'll touch. Okay, same thing on the call side. Here's the call side. Probably out of the money. One standard deviation is 84% out of the money, right? Gray is in the money. Black is out of the money. 84%, close to this, right? What strike is that? Now you know. TOT has an 85% chance of finishing below $124. Okay, and whenever you sell something, you're always selling the bid. You're always selling the bid and buying the ask. So if we're selling something, we're always selling the bid. Okay, so I know it has a chance of touching. So it touched, right? It touched. It's at 119.05. I currently have this call position on. The reason why I didn't roll it is the reason why I rolled. You can see why I rolled the put side up, because I could close it for a profit and sell some more for collect more credit. But what about the call side? Well, let's look at my position. Here's the TOT. What if I want to roll the call side? How do you do it? Click here, click roll your position. Okay. Now, if I want to roll, I need to match. Okay. The faded one is my current position. Okay. The highlighted ones right here are the one I want to roll to. So I want the days to match. So look, see how it's 28 days expiration and currently it's 21 days. I want it to match. So just hit expiration down one. Look, it all matches now. Here's the problem, right? A golden gecko, you sell the one standard deviation out of the money put, right? Well, look. Okay, see that right there? One standard deviation line. If I move this to that one standard deviation line, how much money will I collect? Because here's my current position, right? How much money will I collect? 84 debit. Debit means you have to pay. I'm not going to pay 84 cents to roll, because then you're throwing good money after bad money. This is why we don't roll the tested side usually, unless you do it ahead of time. Well, let's move the strikes out. Watch this. I'm going to extend the timeout and keep an eye out over here, 28 days, and keep an eye out for this. Okay, look, I still got to collect, I still got to pay 83 cents. Let's keep on rolling out. Look what happens. It goes down, but I still got to pay, right? I've got to go all the way out to maybe 84 days, maybe 84 days, okay? And I have to move my striking a little bit, a lot actually, and I still got to pay 8 cents. Okay, so this is why we don't roll the call. We might have to, if we can roll it, we will, if we can get a credit for it. If not, we just got to close the position. Now the other school of thought is Karen the super reader school of thought. Now, if you notice, what you should do is put a good to cancel order where your position will sell itself if you are down double what you collected. Meaning, look, I collected, my cost is $59, meaning I collected $59. So meaning if I have to buy it back, if I collect $59 and I buy it back for $59, I don't make any money, I don't lose any money. Well, there's commissions, right? But if I double this, so 121, approximately 120 bucks, maybe $119, right? I'm sorry, $118. If I double this, meaning if my loss, if this goes to 118 bucks, okay, I should sell it already. Okay, the reason why I haven't is I'm not quite there yet. I'm willing to lose $118 and I'm not quite there yet, but my net lick is really close. So you could just good to cancel and close and just get out of a new trade. You're limiting your losses. That's one way to do it. Now here's what Karen does. Remember now, Karen trades the SPY. Now what she does is she believes she doesn't want to, she tries to be more proactive, meaning she doesn't want to wait till she gets in trouble. So she trades the SPX. Okay, so she tries to sell at least one standard deviation out of the money. So let's look what that looks like, and I'll explain that to you real quick. I got a couple minutes. I'll go choose strategy. I'll go to choose an option. We'll do a short put here, one standard deviation out of the money, right? So look what happens. Okay, so look, she has an 86% chance of being right, not losing any money, at least making a penny, right? Now, what happens if the SPX drops? Okay, and it gets closer to here. Okay, what happens to this number? Well, here's what I mean. To simulate that, I'm going to just pretend and say that this did move this way. To do that, I'm going to move this put up. So let's say right around. What she does is once she gets around this 70%, probably out of the money, she doesn't wait to move it or do anything. She doesn't wait for it to go in the money like this. Okay, she does not want to wait. Once she starts off at 84%, right, out of the money, once she gets to 70 like this, she's watching it really close, and it depends how many days to expiration. Let's say she has like 2 weeks left or 10 days, or she's going to really watch it close. Okay, if it's only like 1 day left, she'll just leave it on. But if there's like 2 weeks or more left, she's really watching it. Why? She doesn't want to get in trouble. So what she'll do is she'll roll it, or she'll close this position, and she'll look at how much money she's down on that trade, right? It's not a full loss, but it's not a winner because it's moving down, right? So let's say she's losing whatever, $1. Okay, she'll close it and sell another one further out, like 80% around here. Okay, so let's say she lost 20 bucks. Okay, on that by closing this trade over here. Let's say she lost 20 bucks. Okay, she moves it out to 80% or so, right? Let's say around 80%. And now look, she's only going to collect $13.50. Okay, but she's down like she lost $20. So there's a difference there of like $6-7, right? $7, let's say that she's down. So instead of selling one put, she'll double up and sell maybe 2 of them. Because watch, if you double click and change the quantity to 2, right? Okay. Well, and then if you click, basically what happens is you're collecting double this amount. Okay, so remember now she lost 20 on the when she closed that other one, she collects maybe what, $26. So she more than made